So we've worked hard to try to operationalize the notion of sustainable development, at least since 1985. We've made good progress in some areas, but less so in others. Since then, we now have another important idea to drive policy, that is green growth. Question, do we need another concept to guide our actions? Is green growth something radically different? And how can the idea of natural capital, which we've heard so much about this morning, help both achieve the goals of green growth and sustainable development? This is the purpose, I think, of my presentation. Let me remind you, I think all of you know what we mean. We talk about sustainable development that meets the needs of the present without compromising the ability of future generations to meet their needs. Many definitions have been followed, but I think none captures the essence of this idea better than this. The main point now of interest in the recent work we've been doing since then, is how to operationalize this concept. What are the key aspects of sustainable development? Again, to remind you, firstly, it takes a long-term view. It isn't looking only at this year or next year, but is concerned with generations to come. It explicitly recognizes environmental constraints. It has a specific reference to equity and eliminating poverty as a central goal. And it seeks development of a system that is resilient. We have heard all of these concepts mentioned this morning. But these four factors are reflected in the vision of sustainable development as encompassing the spheres of economy, ecology, and society. But to move on to how to operationalize it is a little bit more difficult. We've also heard about that this morning, that taking account of environmental constraints in policy and investment decisions has been very much what Pro-Ecoserve has been trying to do. It tries to make sure among the policies that we've tried to promote, to advance sustainable development, has been to make sure that the prices of goods and services reflect the true social costs of the resources used in producing them. This involves eliminating subsidies, imposing taxes to internalize externalities where appropriate. To ensure that environmental risks are fully accounted for in these decisions, and that means to take a precautionary principle. And to value the environmental benefits and costs fully and take them into account when making investment decisions. This may involve looking at economy-wide impacts, and not just impacts in a local area. But that's just one aspect of operationalizing sustainable development. The other very important aspect is to monitor well-being and to use the right indicators of well-being to determine policy. And this means we need to understand some of the limitations of the use of gross domestic product and to move to other indicators which have also been developed, the Human Development Index, and also particularly I will talk today about the use of natural capital. And the third is to provide help for the poor and ensure that policies that address poverty, the policies that we undertake, address poverty and vulnerability concerns. Well, what have we achieved? This might be a good time also to look back a little bit. We've had the operationalizing sustainable development over the last 25 years, and we have some good news as well. We have a growing use of market-based instruments to regulate the use of the environment. We've heard of some examples. Market-based instruments are being deployed in many spheres to address environmental impacts. They're also being introduced more and more in both developed and developing countries. Appraisal methods, when we make major investments, to take more account of environmental impacts, and these appraisal methods have improved, I think, quite a lot the last quarter of a century. a number of the more environmentally motivated subsidies have been introduced to try to encourage cleaner methods of production. And there has been some progress in introducing schemes for the payment of environmental services. And again, Pro-Ecoserve has been particularly interesting in the way it has emphasized the use of these payments for environmental services. But there is also some less good news. The environmental impacts of many of the market-based instruments that we've introduced have been, I would say, modest at best. Because the rates at which these fiscal incentives have been imposed are very low, and they are not based on the real marginal cost of the activities that they are trying to address. There has been much less progress in the elimination of harmful subsidies. Energy subsidies, which amounted to nearly $500 billion in 2008, has actually gone up from $250 billion in 2007. So we still have this issue to address. The subsidies for cleaner production have had mixed benefits. We have problems such as the rebound effect and increased use of energy, which results from the subsidies, which weren't fully appreciated when they were introduced. And although there are alternatives to measuring sustainability and well-being, apart from GDP, the gross domestic product remains, by and large, the most used indicator. We have, of course, developed indicators now of sustainability, happiness, and others, and we have still less use of them. Here's a little example. We can see the blue line there. Was it green? I could be colorblind. Can show you what happens to GDP. This is data from Germany. The same period from 1970 to 2000 shows that happiness indicators don't quite go hand in hand with the increases in GDP. Here is the wider index of the happiness indicators across the world. Having said they don't go hand in hand for that sort of time series, we do see that by and large, the countries in the world which are less developed tend to have lower measures of subjective well-being, as well as what one would broadly call national income or gross measures of wealth. Well, also we have a number of results in terms of indicators which we can look at in the last quarter of a century. And this is also a good time to reflect back. We have had a number of positive developments. We've had improvements in air quality, especially in particulate pollution, across most countries, although more recently this has been reversed. We've had some increases in particulate measures in developing countries, and we are more aware of the costs of particulate pollution, which makes us want to lower the required levels. We've had some upgrading of rivers and lakes, but that has been largely more in the developed world. And we have a greater access, and this was important. I think Pushpan talks about the SDGs. We must remember the Millennium Development Goals have achieved quite a lot in terms of improved water use, of access to improved water sources in the period since 1990. But I suppose probably the most important indicator the last 30 years has been the proportion of the world's population that live below the poverty line. And that has halved from 52% in 1980 to 25% today. That's a decline of 1.9 billion people, from 1.9 billion to 1.4 billion. That decline in absolute numbers is smaller because we just have more people, of course. But of course, these positive trends need some qualification. There has been a growing gap between the quality indicators in the developed world and the developing world, including the emerging economies. The indicators have improved more in the developed world than they have in the developing world. We have emissions of greenhouse gases that continue to increase at alarming rates. We have a degradation of ecosystems and loss of biodiversity that is continuing at a rapid pace. And there are growing concerns of water security and increased impacts from natural hazards. Now, in all of this, we are witnessing deterioration relative to 1990, and projections are, under business as usual, are not encouraging. So we already see other factors. We have 2.4 billion people who rely on traditional biomass for cooking, and heating, and 1.6 billion who have no electricity. And our ability to reduce poverty in the future will be limited by the ecological fragility of the systems in which remaining poor people depend. This is an indicator of the biodiversity, loss of biodiversity since 1970, and this is from the Global Living Planet Index, which shows the kinds of declines we've been seeing. This is a data on the loss of biomes from 1900 to 2000, and we see consistently that we've had losses of between a high figure of 26% to a low of 9%. Sub-Saharan Africa, loss of 19% in this period. So the percentage loss from 2000 to 2050 under current policies is estimated at 12%. So we still have significant problems that we are facing. Let me now turn to seeing how we can measure welfare to try and design policies to address these problems, and to develop policies that will try and reverse the negative trends and the indicators. And in this context, I want to emphasize, we talked about natural capital. It is to how we can use a capital or wealth approach. Now, in the first, let's look at the context. Expanding the system of national accounts can be done in two ways. We can adjust measures of income or consumption to better reflect well-being. As I've already pointed out, the measures currently have a lot of gaps. Or we can expand the boundaries of the system of national accounts to value assets which provide the basis for income and consumption. And it is the second approach which is the one which is taken when we talk about natural capital. So if we follow approach 2, we can link national accounts to social welfare or well-being more easily. We go back to a very famous economist, Samuelson, in 1961, who showed these two sets of figures here. Two countries who have the same production or same GDP of 100. One country is consuming 100. The other country has different consumption. But if you measure just the GDP by production, you'll get them as the same, yet their living standards or the well-being of the people in those two countries is not the same. In first country A, it may be higher initially and stays constant. In country B, it's a little bit lower initially, but then rises. And the idea is that if we want to understand better what true prospect of the present and future consumption is for a country, it is better captured by the measure of wealth rather than the measure of income. This goes back to another famous economist, Fisher, from 1906, who said that we want to measure wealth to measure well-being, present and future. But what is wealth? Well, wealth consists of three kinds of assets. We have immovable wealth, land, fixed structures. We have movable assets or commodities, and we have human beings. And he was interested in measuring wealth, and the idea is that this wealth is equal to the present value of all future consumption. And here, if it is the correct measure, then that's a very important fact, and changes in wealth will tell us a lot about sustainability of well-being. And here I want to give you some idea of attempts to measure total wealth, which is not easy. Of course, the examples you gave from Pro-EcoServe are important, and they'll contribute to improving these measures, but doing it at the national level and in a way which meets the demanding standards of statistics, national statistical offices, has been proving to be a challenge. So we want to include in this measure of wealth, produced wealth, which is structures, equipment, machinery in urban land. And this we can normally get from historical investment data. We have natural capital, which we try to value in terms of the net rents from natural resources estimated using international prices and taking local costs. And then we have a third very important category, which is intangible capital. Includes human capital, the quality of institutions and governance, and normally this is measured as a residual after taking account of the first different two kinds of capital. So we have the total capital in the first column, produced capital, which is the capital, physical capital we made, natural capital, which includes subsoil assets, forest resources, crop and pasture land, protected areas, and others which have not been fully inventoried. And then we have the last one, which is intangible capital, which is human, social, institutional, and others. And the last one is measured usually as the residual after taking account of produced and natural capital. I'll just give you some figures for Kenya since we are here, and we can see the estimates were made. They are not perfect because a lot of categories were not included, but we have produced capital, which is about 13% of the total. Natural capital, as the previous speaker said, is the bigger item, 21% of the total. But the biggest item still is intangible capital, 66%. And under natural capital, we include subsoil assets, timber resources, non-timber forest products, protected areas, and cropland and pasture land. And this chart shows you how those are divided. Now, the great thing that you're doing in ProEcoserve is helping us to improve the way in which that natural capital is measured. Because there are some categories which are measured here, and I won't go into details, rather crudely, rather poor, not so well. And we haven't mentioned anything here about the marine assets and natural capital in that source. But it's interesting that this is the way the way the structure looks. These are the figures for different regions of the world. This data was originally collected by from the World Bank. In low-income countries, the intangible capital is always the largest share. The natural capital share declines as countries have higher income, but in the poorest countries, natural capital is the most important form of capital, more important than produced capital. This table shows you the different kinds of natural capital, and land resource management is critical in the poorest countries. It is a form, cropland and pasture land make up the biggest share of natural capital. And this again means it's very important that we both maintain them, to maintain the value of services they provide, but also estimate them correctly. There's another important idea which came out of the capital accounting, and that's called genuine savings. And this idea says, well, every country has a difference between what it produces and what it consumes, and that difference is the savings. But from the savings, we must deduct the amount of capital which is depreciated, and that takes you down from gross savings to net savings. But we also invest in ways which are not fully accounted for in the savings accounting system, and that is investment in education, which raises savings. But then we mustn't forget to deduct from the savings measure the extent to which natural capital is depreciated and degraded. And that takes us to the fourth chart. And finally, we must deduct pollution damages that are caused from the savings to give us the last figure, which is genuine savings. Now, attempts have been made to measure this for a number of countries, and here you can see three regions, East Asia and the Pacific, with the red line. This is from 1970 to 2000. the Middle East and North Africa, which is kind of bordering around zero, and sub-Saharan Africa, which is well below zero. Now, this indicates that the countries which have negative genuine savings are proceeding unsustainably. They're running down their capital stock. They're living off their capital. Let me now just turn to the last section of my talk, and that is on sustainable development and growth, and how natural capital is relevant to these. Now, sustainable development does not imply zero growth, but rather a growth path that takes account of environmental constraints. And in fact, I would say that in developing countries, sustainable development requires growth in per capita GDP to meet the goals of poverty reduction. And the concept of green growth stresses this aspect of sustainable development. The fact that we need growth to achieve the poverty reduction targets that we have are so important to the overall concept of sustainable development. But is long-term growth possible? Periods of 100 years and so over that. And some people have put some doubts as to whether we can maintain economic growth indefinitely. We don't know. Well, it has been our experience, but only for 200 years. And as a planet, 200 years is a very microsecond of time. But we also know that the available non-renewable resources and capabilities of ecosystems may put a limit on this kind of growth. If we look at the figures on growth data, I just present them to you. This is from data collected by Madison and others for a long period of time. For some of parts of the world, we can go back to about 1820, and we can see the growth rates that people in per capita income that have been achieved, ranging from South Korea, it's a little bit 3%, Japan 2.5%, China since 1870 about 2%, the United States 1.2%. But if we look at Kenya and Sub-Saharan Africa, it's about 0.9% for a shorter period. The data is only available since 1950. Now, the problem is that with this kind of growth rate, it may be not enough to achieve the poverty reduction target, which is so critical to a sustainable, the green growth sustainable development targets. And the other question is, are these growth rates in terms of true, real GDP, or are they measuring a false estimate of GDP? So again, something which we would like to be able to improve through our national income accounting. The other issue which we need to think about is that is medium-term growth possible? And there is a literature which has come about on limits to growth, which has argued that even over 50 years or so, this kind of continued growth which we would need is not feasible. Now, these models have been criticized on the grounds that they've assumed continued trends in the use of fixed resources, whereas growth is more complex and multidimensional, and it can adapt to changes in security. Nevertheless, I think the message we need to take into account is that growth has to be sensitive to trends in scarcity, and we have to design our policies in such a way that it focuses on growth in areas which are less demanding on natural resources and on overuse of natural resources than is currently the case. And the main argument in favor of growth, and I think I'd like to say this is important, is that growth is a key factor of reducing poverty. A 1% fall in growth rate in developing countries implies 20 million more people are consigned to poverty. This was a World Bank estimate in 2008. But the relationship between growth and poverty is more complex. It's not that simple. And it depends on what kind of growth you have. And that's why we use the word inclusive growth in our concept of growth. That is why it is so important. As we say, the impacts of growth and poverty depends on how pro-poor the growth is. If trade exacerbates inequality, it may not be pro-poor. Again, some World Bank data show that while the poverty elasticity of growth is perhaps about 2 on average, could be as high as 4 in countries which have very equal distribution of income, it can be as low as 0 in countries which are very unequal. So this is a very important aspect of growth and the role of growth in poverty reduction. Another important aspect of growth, which has been discussed in the literature and may be worth remembering, is something called the environmental Kuznets curve, which says that we have a U-shaped relationship between environmental quality and development. So at very low levels of income, we may have a high quality of environment which deteriorates in the first phases of development, and then as countries become richer, they become more able to improve the environment again. Now this applies well to some pollutants like SO2, NOx, river water quality. The relationship doesn't seem to apply to greenhouse gas emissions and some other toxic pollutants. And the loss of some biodiversity or ecosystem services is irreplaceable, and therefore this kind of argument doesn't hold to say, well, we can wait until we are richer to try and address the degradation of poverty. I include this graph to show you how the two need not be related, because here we see this is data from the UK. The blue line shows the growth in real per capita GDP from about 1870. The red line shows us the emissions of SO2. And they were very high, went up quite a lot, peaked around 1950, after which were made some significant reductions, but without compromising growth. So it's possible that the two this is an example of the kind of environmental Kuznets curve, but it doesn't hold for all pollutants, and so we can't always argue that this will solve our problems. And there are some other considerations, and one is that sustainable development view of growth, one that takes wider view, and that is that we need to take account of both growth and social and cultural development. And conventionally measured growth may be 0 when well-being is increasing. And these factors also need to be accounted for in the measures of GDP and well-being. Let me now turn to the last section of my talk, which is on green growth and green economy. My time is all right? 5? And this one is really to say that in the green, what does green economy mean? I use the UNEP definition. It's one that results in improved human well-being and social equity while significantly reducing environmental risks and ecological scarcity. Green growth is growth that supports a green economy. Now, it's a little difficult to see how this differs from our operational definition of sustainable development. Two are really very similar. So then what is new in this concept? Well, again, UNEP has stated green economy does not replace sustainable development, but there is now a growing recognition that achieving sustainability rests almost entirely on getting the economy right. And that's a very important message which is coming through from the green growth paradigm. Many of us have always held this view, that operational sustainable development has as its very core. So again, it's emphasizing a particular aspect of sustainable development, which I think is important. So the new content of the green economy, which is very central to us, one was to use the fiscal crisis as a means of promoting green investments and green growth. The use of greening policies as a spur for green growth. The message that greening of economies does not inhibit wealth creation or employment. And to create global markets to promote green objectives, especially sources of funding for green growth. And then to promote new ideas for green development strategies. And all this is important and it's exciting, and it's the way I think we can achieve the goals of the earlier goals of sustainable development. In this context, just a few words on global markets and global finance, and I know some people are going to speak about this later. Green growth places importance on developing global markets for environmental goods and using these to raise finance for green growth. And some of the ideas that have been, areas have been identified. One is a global carbon market. The other is markets for ecosystem services, including RED+, and I know many of you are working very actively on this. The third is reducing protectionist measures that combine with subsidies to harm the environment, the problems in fisheries and agriculture. And the third, last one, is tariffs and intellectual property, IPR issues that limit the transfer of technology. There are problems in all of these. The global market, carbon market, we've been working on this for a long time. There's been huge political resistance. In global markets for ecosystems, we've made some progress, and I'm delighted to see the work that ProEcoserve is doing here on PES schemes. They're hard enough at the local level, but there are many problems still in making them operational. Monitoring and verification issues still remain, and they are still quite significant problems to address. To reduce protectionist measures, we are making some progress here, but this is also a very slow process. And the transfer of technology, and there are now some innovative developments here that may help to ease the transfer. Mechanisms to raise the finance for global green growth are also being explored in this green growth literature. One is, of course, we know the role of GEF, which has been quite significant in raising money, but still, relative to the needs of global finance, it is small. There's been the use of some revenues from cap and trade for financing public goods, but again, it's been relatively minor. We talk about a possible global tax on greenhouse gas emissions, and if this could be achieved, the revenues would be very substantial, and they could indeed transform. We talked about the transformational change. This could be one way of achieving that. One is the International Finance Facility, which could issue long-term bonds underwritten by donor countries to finance development expenditures in a way that's now done for immunization, is also a possible and exciting idea. And then we have the possibilities of financial transactions tax, or a currency tax, sometimes known as a Tobin tax, which could also raise a huge amount of money if it could be implemented. There are difficulties with all of these. GEF draws on public funds, and the appetite to increase allocations is limited. The governments are generally unwilling to earmark part of their revenues for a given purpose, which is what you need for carbon tax. A similar problem arises with operating and designing a global carbon tax, and unwillingness to agree on a harmonized scheme. But at least for the carbon tax, there's no need for pooling of revenues. I think there is some scope for an international finance facility. And again, the difficulties which exist with global agreement on these taxes is significant. Although few countries have now introduced the financial taxes, including France in Europe. So just some concluding thoughts. A lot of intellectual energy has gone into working out how to make sustainable development happen. Some of this has been translated into action, I think along the lines I've indicated. There has been progress in some areas, less so in others. So green growth emphasizes two key ideas in sustainable development: the importance of growth to reduce poverty and the importance of economic instruments. Progress to sustainable development and green growth will be helped by measuring well-being correctly. The right measure of capital is critical for that. This includes physical, natural, and tangible capital. Now, your contribution to helping understand better the role of natural capital is critical in this. Thank you.